Hello everyone, welcome back to this session. In this session, our focus is going to be the critical factor that explains why interest rates vary across different debt instruments. And by using the tool of credit rating, we explain why it varies. So in real world debt instruments, not all borrowers face same cost of borrowing. Even for loans or bonds of similar maturity. So here the credit ratings issued by independent agencies play a vital role in this differentiation. So they reflect the perceived risk of default and as a result directly influence the interest rate or yield that investors demand. So this topic is especially important in the context of economic environment and business strategy course for firms, government and investors. Credit rating shape access to capital, determines borrowing cost and signal financial health to markets. So for managers and strategists, understanding how credit risk is priced and how is perceived can offer a competitive edge in corporate finance and investment planning. So in this session, more specifically, we will explore how credit ratings are constructed and interpreted, and subsequently we will examine the differences between investment grade and junk grade of bonds, and understand the role of domestic and international rating agencies, including how their evaluation impact investor behavior and borrowing costs. And then subsequently, we look at the real world examples from both government and corporate bond markets, including the case of India. So by the end of this lecture, I hope that you will understand how credit ratings act as a bridge between macroeconomic fundamentals and financial market outcomes, and how they influence business strategy and in a world of capital mobility and investor risk assessments. So let's begin with the question, what is a credit rating and why does it matter so much to financial markets? So to understand this one, let us do a follow-up from our previous session where we discussed that there are several rating agencies. Let us begin with one of the rating agencies' rating scale. For example, Moody's Global Long-Term Rating Scale. So in the previous session, I have mentioned AAA ratings. While explaining the figure of interest rate movement, I have used the term called AAA ratings, AAA corporate bond. So AAA means the highest quality of debt instruments. So that means obligations rated AAA are judged to be the highest quality subject to the lowest level of credit risk. That means the perceived default risk of this debt instrument is, or this financial institution also, the default risk is very low. That means high quality bonds. Those who are getting AAA, or those countries, those who are getting AAA ratings, those firms who are getting AAA ratings, they are considered as very, very low risk. That means they need to pay low rate of interest when they raise finance from the debt market. Then it follows AA, A. Then in the rank, the bottom, then you can see that BAA. This is the term I used in the previous figure, where the obligations rated BA are judged to be medium grade and subject to moderate credit risk, and as such may possess certain speculative characteristics. Then we have BA and even further lower grade. That means when you read from here, the top to bottom, what you can see, the top is the high quality, that means highly rated, that the low risk. So when we go down, we can see that the ratings go down, the perceived default risk increases. Then we have another category that is called CAA. CAA means obligation rated CA are yet to be speculative of poor standing and are subject to very high credit risk. Then CA, and finally there is C. So look at, for example, the C, obligations rated C are the lowest rated and are typically in default and with little prospect for recovery of principal or interest. So overall, these are all called speculative graded bond or junk rated junk bonds. Shortly, we call it as junk bonds. Those bonds with these kind of ratings, we call it as junk bonds. So moving further about the global short-term rating scale, I start with the P1, that is the prime one. It reflects a superior ability to repay short-term obligations. So mainly corporate commercial paper, that kind of debt instruments, they get P1 rating. Then in the rating, you can know the second quality rating is P2. Then we have P3. NP, issuers rated as not prime, do not fall within any of the prime rating categories. So let me summarize this one. The standard linkages between global long-term ratings and short-term rating scale. So these are all long-term ratings, as we have already seen that those who are getting AAA ratings is considered as superior quality. That means the perceived default risk is very low as compared to here the junk rating. So the corresponding rating P1 is for AAA to A3. This one is prime rating, and this one is accordingly you can see the ratings. So these are all not prime. So I am giving you a summary of 3 international rating agencies rating scale. So there is slight variation, differences in the rating scale they use, but overall these are all comparable. So you can see Moody's starting with AAA, S&P also use AAA, Fitch also use AAA, but here slightly it varies. Here AA1, here AA2, AA plus, here AA plus. So overall what you can see that those who are getting AAA, this is prime maximum safety. So those bonds which gets a ratings of AAA, that is considered as superior quality. That means the default risk, the credit risk is very low, and accordingly they need to pay low rate of interest in the market. So in order to sell, they need to pay low rate of interest, and the investors, the lenders, if they want, they would like to give more priority for the safety, then they are going to buy AAA rated bonds, but you know that they are going to get the yield to maturity that they are going to get is going to be low. So I also give some quotation for junk bonds and fallen angels. Junk bonds I already mentioned, those who are coming here, these are junk bonds. A fallen angel is a bond that has been reduced to junk status because its issuer has fallen into financial trouble. So especially during 2007-8 financial crisis, initially it was a real estate crisis, later on it became a financial crisis, and further it became an economic crisis. So at that time, many AAA rated bonds and firms, they have fallen because of the financial trouble, and after the financial crisis, they had been rated as junk bonds. Their ratings fell to here, this grade. Then it is called as fallen angels. So its bonds pay higher returns than investment. So investment quality bonds, but are riskier. So this is also further summary and some of the companies, those who get higher ratings. So you can see in the corporations, for example, these companies, they have been rated as AAA. For example, Microsoft and the country Canada, they have been rated as, they got AAA ratings. And AA, you can see General Electric, Procter & Gamble and China, they have AA ratings. Many low and middle income countries, their ratings often goes much bottom, somewhere they fall somewhere here. So about the commercial paper ratings, commercial paper rating is the short-term credit instruments ratings. So here also I have some examples who got prime P1 rating, who got P2 ratings and who gets P3 ratings. So I'm giving you some web links for the rating agencies. So when you click here, you will get the data on the ratings received by various countries over time. And I also giving some link from Wikipedia where you can see the list of countries by credit rating and which country, based on that you can make a inference which all countries enjoy superior credit ratings, and because of that they can earn at a low rate of interest from the market. That means their cost of borrowing is very less, and in contrast to this, those countries having low credit rating, they need to pay high rate of interest in the market to borrow. So here I'm just showing you the ratings by Moody's, S&P and Fitch ratings. You can see US, they're having AAA, then UK and Australia. You can see Australia also having AAA ratings. So these are the ratings for various countries. If you go through the link which I shared with you, and you will get more information and more data on the ratings, the sovereign ratings for each and every country in the world. I'm showing you some screenshot for the credit rating for India. So from the rating agencies, you can see that Fitch has rated India with BBB minus. Moody's rating is Baa3, and they have given here stable ratings, the outlook with a stable outlook. So from this rating outlooks, watches for the agencies are the following. One, positive means the rating may be raised in the future. So then negative rating means that a rating may be lowered in the future. And stable means there is a rating is not likely to change in the coming days. So here you can see that this period, all the rating agencies given, all the three rating agencies, though the rating is low, but they have given a stable rating. That means in the near future, there is less likely that these ratings are going to change. But in 2020, even in the postmath of, especially during the COVID time, all these rating agencies gave us a negative outlook. That means in the coming days, coming rating, they are going to degrade our ratings. But then positive was there in 2015, 2014. So while going through this website, you will get most up-to-date updated rating for India. What are the factors that determine the sovereign rating? So I'm showing you here the factors that these rating agencies consider while giving sovereign rating. So the main factor is that affect the sovereign's government willingness and ability to service is financial obligations to non-official creditors on time and in full. So the criteria vary across the rating agencies, but overall we can club all these things into 5 main categories. So one is institutional assessment. Second one is economic assessment. Institutional assessment is how strong, how robust are the institutional foundation of the country, how strong is the economic foundation of the economy. Then the external assessment of the economy. Fiscal assessment. Fiscal assessment means the fiscal position of the economy, of the what is the total budget size, what is the total expenditure, and what is the total revenue, and what the budget fiscal deficit, what is the borrowing requirement of the government, and what is the interest payment obligations for the country. That all will be included, plus the monetary assessment, how stable is the inflation in the country, and how consistently or stably the country has been following the monetary policy, and how strong is the monetary authority, how credible is the monetary authority and monetary policy framework in the country. So all these factors, you know that it varies from countries to country, it varies from time to time. All these reflect the sovereign ratings by these three international rating agencies. So what are the implications? Why the countries worry about their sovereign rating? Why they give importance to the sovereign ratings? If suppose a country get a AAA rating and the other country get, for example, B AA rating, how does it matter? So here it matters mainly because one, if high superior rating means you need to pay low rate of interest if you want to borrow from the market, right? And here the rating is a mapping of the probability of default, which depends on the ability to repay and willingness to repay. So the criteria for sovereign ratings are mainly based on fiscal discipline, debt servicing, stability, and reputation. So if a country gets poor ratings, it affects its business environment as such. Because a countries with poor rating, the firms working in that country also carry the similar risk. They need to pay high rate of interest in order to raise external finance. That means high cost of production. So it is going to have adverse effects on the business environment. So similarly, there is going to be low foreign direct investment. So in many countries, for example, in the US and other developed countries, the institutional investors such as pension fund and mutual fund and insurance companies, they are not allowed to invest in those countries where the sovereign rating is below certain critical threshold. So that means it's going to have an adverse impact on the foreign direct investment. So the reason and consequence, talking about the reason and consequence of poor sovereign ratings, one of the main factor is the fiscal deficit. That is one of the main criteria, and that is the reason you can see over the years the government of India has been trying to reduce the fiscal deficit, that is the borrowing requirement from the market. So high fiscal deficit will lead to so low sovereign ratings, which would lead to high rate of interest, and many foreign governments won't allow their companies to invest in countries with low sovereign ratings. So it has negative implications for economic growth, and in addition to this, political and economic system stability and the credit worthiness also matters in the poor sovereign ratings. So when it comes to the impact of ratings on yields, so how I explained in the beginning of this lecture is that when a company or a debt instrument is getting a superior rating, AAA rating for instance, so they need to pay low rate of interest for raising capital from the money from the market. So then those who are having low default risk, those who are getting high rating, they have been considered as the benchmark bonds. So globally, the US Treasury bill is considered as the benchmark bond. So the yield on other bonds are measured in terms of spread over Treasury. So the bond yield, suppose if you want to take about the bond yield of India, so we normally express it in terms of what is the yield, the rate of interest for US, that is the benchmark bond, plus the default risk premium by India. So in this case, inside one, so higher the default risk, higher will be the yield. So when treasury yields move, when this one move, then all other yields move with them. So if bond rating properly reflect the probability of default, then the lower the ratings of the issuer, higher the default risk premium and hence high interest rate. So I'm showing you a comparison, an international comparison of 10-year government bond yield. So starting with Switzerland, they're actually the negative yield. That means somebody buying government bond, Switzerland government bond, they need to pay the government for buying their bond. That means investing in Switzerland bond means a kind of safely parking your money. But in contrast to this, look at the countries here, you know that the rate of interest is very high. That means the default risk is very high. So talking further about the benchmark bond, as I mentioned that US Treasury bonds are considered default free. So here, what is the difference between, for example, we want to compare between India bond and US bond. So then suppose in the US, the rate of interest is 2%, and whereas in India, in the US, for example, this is 2%. In India, for example, this is going to be 7%. So then the difference between the benchmark bond and the Indian bond, that is going to be 7%, 7 minus 2, that is going to be 5%. So this is the risk premium. So the spread between interest rates on bonds with the default risk and the interest rates on same maturity treasury bonds. So normally the leading financial dailies, they publish risk spread or the risk premium periodically. So let us look at this table. So here what I'm showing you that the country's name, you can see the countries, then the S&P rating and the 10-year yield and spread between US bond vis-a-vis this country. So you can see here Switzerland, this is minus 2.96%. That means as compared to US bond, the benchmark bond, Switzerland is the least, that means key bond, that is the superior quality bond. Then here US, obviously the benchmark, so the risk spread is 0. But when you look at, for example, India, you can see the risk spread is 5.18%. In Venezuela, you can see this one is very high, 43.11%. For example, what you can see that the Venezuelan government, they want to borrow from the market. For a 10-year bond, they need to pay per annum 45.98% as the rate of interest. So you can see some countries here, these countries, they need to pay high rate of interest. Accordingly, their risk spread is also very high. So I am showing you another figure by the risk spread of select countries as compared to US. This is the US, the benchmark. Obviously, the spread is 0. So you can see Germany and Canada has much superior risk rating, than the superior ratings, credit quality as compared to US. And countries like India, Brazil, and all these countries, the risk spread is much higher as compared to the US. So having discussed the default risk, bonds with the same maturity have different interest rate due to one default risk. Apart from default risk, there are other factors also determine the structure of interest rate. One is called liquidity. Liquidity means the cost of selling a bond. Suppose the bond market, the secondary market is well developed and is highly liquid. There are large number of buyers and sellers in the bond market, and you can buy or sell your liquidity anytime, whenever you want. That means the liquidity is very high. So that means that when the liquidity is very low, the rate of interest also will be low. When the liquidity is very high, the rate of interest will be low. When the liquidity is very low, there is no less liquid, the finance with the debt market is less liquid, then the rate of interest is going to be high. Then the tax consideration also matters, mainly income tax consideration. So income tax consideration means the interest payments on municipal bonds are exempt from federal income taxes. So that means municipal bonds means the bonds issued by the local governments. So I'm giving you an example, an illustrative example here. Consider a 1-year $100 face value taxable bond with a coupon rate of 6% with a 30% tax rate. So after tax bond yield, we are going to see what is the after tax bond yield. So here consider a 1-year 100 face value taxable bond with a coupon rate of 6%. This is a promise to pay 106 in 1 year. So if the bond is selling at par at a price 100, then the yield to maturity is 6%. So from the point of view of the government issuer, bondholder receive 6 in taxable income at maturity. So if the tax rate is 30%, the tax on that income is going to be $1.8. Then so the 100 bond yields 104.2 after taxes. So in other words, at a 30% tax rate, a 6% taxable bond yields equivalent to 4.2% return. So here, what if the municipal bonds are tax-free? Suddenly, government announced that the municipal bonds are tax-free. So here, what you can see that when it becomes tax-free, the demand for municipal bonds increases. Then as a result, you can see that the bond price increases. That means rate of interest declines. At the same time, you can see its competitor, that is the treasury bonds issued by the federal government. Its demand declines and its price declines. That means its rate of interest increases. So what you can see here is that when a tax-free status is announced for municipal bonds, then its demand curve shifts rightwards, leading to a decline in rate of interest. And at the same time, its competitor, the treasury bonds, its demand curve shifts leftwards and its rate of interest increases. That means a market adjustment takes place. So with the result that municipal bonds end up with a higher price and a lower interest rate than on treasury bonds. So here I have a real world example, the Obama tax increase on bond interest rate. In 2013, Congress approved legislation favored by the Obama administration to increase the income tax rate on high income taxpayers from 35% to 39%. So consistent with the supply and demand analysis, the increase in income tax rates for wealthy people help to lower the interest rate on municipal bonds relative to the interest rates on treasury bonds. So let me now show you some examples of tax-free bonds in India. The Rural Electrification Corporation, National Highway Authority of India issued bonds are tax-free. So that means when they are tax-free, high net worth people, they are going to invest in these kind of bonds to save their tax. Thank you for watching this video. See you in the next session. Thank you.